Right now, the multi-trillion-dollar race to build artificial general intelligence might actually be halted by a global shortage of the exact same gas we use to fill party balloons.
Yeah, it sounds like a joke, but
Yeah.
it's really not.
No, it's serious. And meanwhile, traditional banks over in Asia are being handed these strict 6-month ultimatums by regulators to adopt blockchain technology. And on top of all that, biotechnology firms are basically throwing out a century of established neurological science.
Right, it's a massive shift.
So, welcome to the deep dive. Today, we have a stack of sources that looks like it was dropped off by 3 completely different people. We've got stuff from a tech hardware analyst, a Wall Street crypto trader, and a biotechnology researcher.
And honestly, on the surface, those feel like totally unrelated worlds.
Completely unrelated. But our mission today, for you listening, is to uncover the hidden connections across all these high-growth sectors. Because whether you're looking at AI infrastructure or digital asset regulation or, precision neuroscience, they are all hitting the exact same evolutionary milestone right now in March 2026.
Exactly. It is the definitive end of the whole move fast and break things Wild West era.
Right. The Wild West is over.
It is. We are transitioning into an era of just incredibly disciplined, highly regulated precision.
So just to set the table, the materials we are unpacking today include the 2026 Institutional Investor Digital Asset Survey from Coinbase and EY. We've got a Morningstar report on the Middle East conflict's impact on AI chips. We're looking at strategic updates from the Hong Kong Monetary Authority and China CITIC Bank. Also, a landmark SEC and CFTC regulatory memo. And finally, a recent earnings report from a clinical stage biotech firm called Rapport Therapeutics.
It's a lot of ground to cover,
Uh-huh.
but the core thesis you really need to keep in mind here is that knowledge isn't just about understanding one single sector.
Right.
It's about seeing how the bottlenecks in one industry perfectly mirror the breakthroughs in another.
A bottleneck in one forces a breakthrough in the other. I love that. Let's start with the most literal, physical bottleneck imaginable. Because, when we think of AI, we think of the cloud. We think of software, the metaverse.
Something totally weightless.
Yeah, exactly. It feels ethereal. So it's fascinating to realize that the limit to our futuristic AI utopia might literally be a shortage of helium. Like the stuff from party balloons. It's like trying to build a digital skyscraper, but realizing you are totally out of physical steel.
Yeah, the irony of the cloud is that it is incredibly heavy. I mean, the foundation of AI isn't just code. It is these massive, energy-devouring data centers.
It's just rows and rows of servers.
Right, filled with highly specialized physical hardware. And that hardware requires very specific, highly localized earthbound materials.
Which brings us to this Morningstar report. It analyzes the ongoing conflict in the Middle East, specifically involving Iran, and how it's threatening the AI chip supply chain, like big tech Apple, NVIDIA, Microsoft. They are facing potential shortages.
And the timing couldn't be worse. The tech industry is right in the middle of this unprecedented build-out of AI infrastructure.
Just buying up every GPU they can find.
Exactly. The demand for parallel processing GPUs is astronomical. We're already seeing downstream shortages where automobile manufacturers can't even get basic chips because the foundries are completely consumed by feeding the AI machine.
Right. There is no margin for error in the supply chain.
Not at all.
So let's unpack these specific resources. Because Morningstar doesn't just vaguely gesture at metals, they specifically point out helium, aluminum, and bromine in the Middle East. Why, helium, I just thought of it as the gas that makes your voice squeaky.
Right. Well, that association kind of trivializes it. Helium is actually a critical industrial gas. It all comes down to basic thermodynamics in chip fabrication.
Okay.
So to make a modern microchip, you take a silicon wafer and you deposit and etch microscopic layers onto it to create transistors.
And these are tiny, right, like nanometers?
A few nanometers wide, yeah. And this process, specifically plasma etching, generates an immense amount of heat. Plus, it has to be done in a highly controlled vacuum environment.
So you've got this microscopic, super delicate piece of silicon sitting in a vacuum, getting blasted with plasma, and generating massive heat. I imagine if you don't cool it down, it just melts.
It melts or it warps. It's ruined.
Wow.
And you can't just blow cold air on it. Standard air has oxygen and nitrogen, which are reactive.
Oh, right. They'd chemically bond to the silicon.
Exactly, and destroy the chip.
But helium is a noble gas. It's completely inert. It will not react with the materials in the chamber. And more importantly, its atomic structure gives it an exceptionally high thermal conductivity.
So it pulls the heat away really fast.
Faster than almost any other substance, yeah.
Yeah.
Without ruining the product.
It's basically the ultimate thermal escape hatch. So if you run out of helium, you
Yeah.
literally cannot cool the wafers fast enough. The whole fabrication process just stops. It halts entirely. And helium extraction is tough. It's usually a byproduct of natural gas extraction, and the Middle East is a huge hub for that.
Okay, so that explains the helium. What about bromine? Because Morningstar highlights that too, mostly coming from the Dead Sea region. What on earth is bromine doing in an AI data center?
It's the chemical foundation for high-performance flame retardants.
Oh, because the servers get so hot.
Exactly. You pack thousands of these AI chips tightly onto circuit boards, running massive neural network training models for weeks. The racks run incredibly hot.
So flame retardants aren't just a nice to have.
No, they're a fundamental safety requirement. It's dictated by global fire codes. Legally and practically, without bromine-based retardants, you cannot deploy those servers.
That is just wild. The entire utopian vision of AGI is tethered to the chemical properties of water in the Dead Sea.
It's a massive reality check.
It really is. And the timeline the report gives is scary. They quote Dan Ives, the global head of tech research at Wedbush Securities.
Yeah, his perspective is really important here.
Right. He frames it as a ticking clock. He says if the conflict resolves by mid-April, it's just a, quote, rounding error for the tech sector. But if it extends into May, it causes severe, prolonged supply chain issues.
One single month is the difference between a rounding error and a systemic crisis.
That's incredibly fragile.
It shatters the whole illusion of a frictionless, globalized supply chain. Tech executives are waking up to the fact that their trillion-dollar software valuations depend completely on physical geography and geopolitical stability.
Exactly. So put yourself in the shoes of a multinational corporation. Say you're a global shipping firm, and you're watching this physical shock unfold. It instantly scrambles your financial reality.
Right, your supply costs skyrocket, your currency exposures shift wildly.
And you need to move capital instantly to secure alternative resources. But, and this transitions us to our second sector, perfectly traditional institutions aren't just sitting around waiting to be disrupted. They are fundamentally rewiring their operating systems.
And they have to, because when that corporation faces a sudden shock, they turn to their bank to hedge the risk and make emergency cross-border payments.
But legacy banks are built on, 1970s mainframe technology.
Yeah, to really understand the friction, think about how a cross-border payment actually works today.
Okay, let's say a client in New York needs to send millions to a supplier in Singapore right now.
The money doesn't just teleport. Traditional banks use a correspondent banking model. The New York bank might not actually have a direct relationship with the bank in Singapore.
Because so do they do.
They send a message over the SWIFT network to a larger intermediary bank, maybe in London, asking them to adjust their shared ledgers.
The Nostro and Vostro accounts, right?
Exactly.
It's basically a global high-stakes game of telephone. Bank A tells Bank B to tell Bank C to debit an account.
And every single hop introduces friction. It takes days for ledgers to settle, it adds counterparty risk, and every middleman takes a fee.
And during a geopolitical crisis, when currencies are fluctuating by the minute, a 3-day delay is just a total non-starter.
Right. Your working capital is trapped while the market moves against you.
Which is exactly why we're seeing this massive regulatory push out of Asia. We have this circular from March 2026 from the Hong Kong Monetary Authority, the HKMA.
And it is not a polite suggestion.
No, it's an ultimatum. They gave authorized institutions just 6 months to submit a formal strategic business plan. And it has to address the convergence of 3 things: distributed ledger technology, agentic artificial intelligence, and cloud computing.
The HKMA is explicitly telling these legacy banks that simple digitalization is over. Putting a slick UI on a mobile app isn't enough anymore.
Right. They want a fundamental restructuring using DLT.
Because DLT solves that correspondent banking nightmare we just talked about.
Right.
It replaces that sequential game of telephone with a single, mathematically verified state of truth.
So instead of Bank A updating its private ledger and sending a message to Bank B,
all participating institutions just share access to a distributed cryptographic network. When New York authorizes the payment, it's verified by consensus and settled almost instantaneously.
the money doesn't travel. The ledger just updates.
Exactly. It completely eliminates the friction of distance.
And the HKMA is setting up a supervisory incubator for DLT to help them do it.
Which is brilliant because regulators are usually reactive. They wait for you to mess up, then fine you. An incubator is a proactive sandbox.
It's a safe place to test it out.
Right, without introducing systemic risk to the whole financial system.
And we're already seeing what happens when banks actually lean into this. Look at China CITIC Bank. They didn't wait for the deadline. They are totally re-engineering their operating system.
They're a prime example. Look at their demographic strategy.
Yeah, they're deploying AI models on WeChat and Douyin to target prospects. And this drove a 15% reduction in cost per acquisition.
And we should clarify the circular mentioned agentic artificial intelligence.
Right. How is that different from, say, ChatGPT?
Generative AI just answers prompts. Agentic AI is autonomous. These are systems designed to pursue specific goals, make decisions, and execute multi-step workflows without a human constantly clicking buttons.
So China CITIC has autonomous agents out there analyzing user behavior on Douyin and actively acquiring clients.
Yes, and the real game changer is how they use it for lending. They're using big data credit models to approve SME loans, small and medium enterprises.
Which is notoriously hard to underwrite, right?
Incredibly hard. Small businesses don't have decades of audited financials. A human loan officer takes forever to manually underwrite that risk.
It's expensive and slow. But China CITIC is using AI to ingest real-time cash flow and digital payment volume and underwriting it autonomously.
And they pushed 96% of their retail volume to mobile.
It's incredible. Here's where it gets really interesting to me. It's basically like these banks are trying to swap out their entire engine while driving down the highway at 80 miles per hour.
That's exactly what it is.
Because at the same time, you have high net worth clients demanding complex ESG investments and bespoke family trusts.
And to manage a complex ESG portfolio, you have to process massive amounts of data, carbon footprints, supply chain ethics. A legacy mainframe can't do that.
Yeah.
It requires cloud AI and the transparent record keeping of a blockchain to prove you're actually meeting the ESG mandates.
So banks are backed into a corner. Corporates need instant settlement. SMEs need AI credit. Rich clients need blockchain transparency. And regulators are holding a stopwatch.
Right. So if century-old legacy banks are being forced by regulators to adopt DLT just to survive, what is happening to the institutions that were already native to digital assets?
That is a perfect transition into our third section, crypto's institutional era. Because we have this massive 2026 Coinbase and EY survey.
They surveyed 351 institutional decision makers, hedge funds, asset managers.
And the data is wild because despite massive market swings over the last year, an overwhelming 73% of institutions plan to increase their digital asset allocations in 2026.
It's a staggering display of conviction.
And I have to stop and ask about this because we're telling you, the listener, that 73% are buying more. But last week, Binance reported nearly $60 million in net outflows from Ethereum Spot ETFs in just 1 week. So if $60 million is fleeing the market in days, how on earth do we reconcile short-term panic with long-term institutional bullishness?
You have to separate retail psychology from institutional mandates. Retail operates on sentiment, fear, and greed. They panic sell. Institutions operate on a completely different timeline.
The report literally titles the section, "Volatility Drives Discipline, Not Retreat."
Which perfectly captures their mindset. Think back to the dot-com bubble. Retail fled when the market crashed. But institutional venture capital used the crash to find the companies with actual utility.
They weeded out the garbage.
Exactly. Extreme volatility is a stress test. An institutional manager doesn't say crypto is dead. They say, did our custodian survive? Did liquidity freeze?
And the survey says 49% of firms actually strengthened their risk management and position sizing because of the volatility.
They stopped viewing it as a casino and started viewing it as a durable asset class that needs proper plumbing.
The data on what they want from custodians proves that. In 2025, only 25% cared about regulatory compliance in a custodian. In 2026, that skyrocketed to 66%.
It's not a peripheral concern anymore. It's the gatekeeper.
And security protocols jumped from 8% to 66%. Meanwhile, cost is no longer the main driver. Concern over fees plummeted.
Right, because if you manage a $10 billion endowment, fighting over custody fees is pointless if your custodian gets hacked or frozen by the SEC. Legal certainty is existential.
And they are using stablecoins as the new plumbing. 85% use or plan to use them for internal cash management.
Because stablecoins enable instantaneous T0 settlement, the asset and the payment transfer at the exact same time.
Which kills the counterparty risk of that 3-day SWIFT delay.
Exactly.
Yeah.
And beyond stablecoins, 61% expect tokenization to significantly disrupt market structure in the next 3 to 5 years.
Tokenization, like putting real estate or bonds on a blockchain.
And baking the legal rules directly into the smart contract.
It's amazing. But there's a huge hurdle, right? 66% say regulatory uncertainty is their primary concern.
The tech has completely outpaced the legal frameworks. You can't deploy billions of dollars on regulatory quicksand.
Which brings us to Section 4. The regulatory gatekeepers are finally harmonizing. Let's look at this landmark March 2026 Memorandum of Understanding between the SEC and the CFTC.
Signed by Chairs Atkins and Selig.
This is massive.
Explain why it's such a big deal, because historically these two agencies did not play nice.
No, they didn't. The SEC regulates securities, basically, investments where you expect a profit from someone else's work. The CFTC regulates commodities and derivatives like gold or wheat.
But a crypto token kind of shapeshifts. It might start as a security to raise money, but later function like a commodity on the network.
And instead of collaborating, the agencies fought a turf war. Firms would spend millions complying with the CFTC, only to get sued by the SEC.
It's that duplicative, contradictory oversight that paralyzed the institutions in the EY survey. But this MOU is a ceasefire. They are pledging joint product guidance and an end to duplicative exams.
Which saves firms so much time and money. The report talks about this concept of the minimum effective dose of regulation.
Right, just enough oversight to ensure market integrity without smothering innovation.
I think of it like sports. For years, crypto has been playing a game with two referees on the field, blowing whistles from two completely different rulebooks.
Yeah, one calling a basketball foul, the other throwing a football flag.
Exactly. And the players are just paralyzed. Now, they finally agreed on the rules, and this opens the door for what the report calls super apps.
A unified financial Swiss Army knife for consumers. You can trade equities, hold tokenized real estate, and send stablecoins all in one app because the regulatory structure is finally harmonized.
And we also have the U.S. Genius Act, which 83% of investors say will drive stablecoin adoption. And globally, Hong Kong is issuing fiat-referenced stablecoin licenses.
Hong Kong is really focusing on market depth. They're utilizing a wholesale CBDC platform called Ensemble TX.
Which is for interbank settlement, not retail consumers.
Right. They are physically building the digital rails for institutional tokenization.
So tech needs physical minerals. Finance needs digital plumbing. Crypto needs clear rules. The theme is moving away from a scattershot approach toward highly targeted discipline.
And nowhere is that shift more literal than in our final sector today, biotechnology.
Section 5. We are looking at the Form 8K from Rapport Therapeutics.
At first glance, brain chemistry feels completely disconnected from blockchain regulation.
Totally. But look at the strategy. Traditional neurology drugs were blunt instruments with heavy side effects. Rapport is practicing precision neuroscience. It's exactly what the SEC is doing, moving from blunt enforcement to specific, targeted frameworks.
The biological connection is brilliant. Let's look at Rapport's lead program, RAP-219. They just announced robust Phase 2A results targeting focal onset seizures, or FOS.
And they are prepping for Phase 3 in Q2 2026.
Right. Historically, treating a neurological disorder was like chemical carpet bombing.
Yeah, because focal onset seizures are just localized electrical storms in one part of the brain. But traditional drugs depress the entire central nervous system.
Which is why patients get severe drowsiness and cognitive impairment.
Right. It's like if your toaster is short-circuiting, you don't go to the basement and shut off the main breaker for the whole house.
Exactly. You stop the fire, but you kill the fridge and the Wi-Fi.
But Rapport is taking the opposite approach.
They are targeting highly specific neural receptors. For example, their alpha-6 beta-4 candidate for chronic pain and migraine.
Let's break that down. Alpha-6 beta-4.
Traditional opiates are like a master key. They bind to receptors everywhere: the brain, spinal cord, gut.
Which blocks pain, but also depresses breathing and causes addiction.
The sledgehammer approach.
Mm-hmm.
But alpha-6 beta-4 receptors are primarily expressed only in specific pain pathways. Rapport's molecule is a key tailored only to that specific lock.
The smart grid approach. Find the minimum effective biological dose.
Exactly. And this discipline extends completely to their balance sheet, echoing the crypto institutions.
Oh, totally. The 8K shows they secured a massive $490.5 million cash runway, lasting into the second half of 2029.
A 4-year runway is exceptionally rare in clinical stage biotech. They insulated their science from market volatility. Volatility drives discipline.
And rather than going it alone globally, they executed a targeted $308 million strategic licensing deal with Tenacia Biotechnology to handle the Greater China market.
Outsourcing regional regulatory complexity to a localized partner, maximizing leverage while minimizing exposure.
It's the corporate equivalent of precision medicine.
So when you synthesize all of this, whether you're allocating capital to digital assets, revamping a traditional bank with AI, or curing epilepsy, the era of growth at all costs is dead.
We are firmly in the era of precision and discipline.
Absolutely.
It's been an incredible journey today. We navigated the supply chain of AI chips, the digital transformation of global banks, the institutional maturation of digital assets under unified regulations, and the highly targeted future of precision neuroscience.
But I want to leave you, the listener, with a lingering question.
Lay it on us.
We've seen how physical geography dictates AI. We've seen how regulation dictates digital finance, and how genetics dictates biotech. But as these super apps and agentic AI systems become deeply integrated into our daily lives, our banking, our healthcare, what happens when the precision of biotech, the tokenized rails of global finance, and the raw computing power of AI all fully converge into a single ecosystem?
Wow.
A world where your biology is monitored, analyzed by AI, and the treatments are instantly hedged and settled via stablecoins, who will ultimately control the physical resources, the helium, the aluminum required to keep that massive interconnected machine running.
Because whoever controls the physical bottleneck ultimately controls the entire digital reality. That is a staggering thought to end on. Thank you so much for joining us on this deep dive. Keep looking for the hidden connections in your own world, and we'll see you next time.